The Pfizer stock, under the ticker PFE, is currently trading at $24.53 per share, reflecting an intraday movement of down $0.13 or minus 0.53% as of the last market check at 12 p.m. EST. Now, the common expectation following a pharmaceutical giant's earnings release is a straightforward reaction. Did they beat or miss on the top and bottom lines? For Pfizer, the reality is far more nuanced and creates a critical tension for investors, particularly those managing their own portfolios through platforms like Interactive Brokers or using a straightforward tool like Robinhood stock trading. The company just released its third quarter 2025 results this morning, and while the stock is modestly down, the true story is that they delivered a massive beat on adjusted earnings per share, hitting 87 cents against an analyst consensus of only 64 cents. This is an enormous 36% earnings surprise. However, the top-line revenue at $16.65 billion slightly missed the street's expectation of $16.76 billion. The immediate, surface-level narrative is that revenue is down due to the expected decline in COVID-19 product sales, specifically Comirnaty and Paxlovid, causing the stock to pull back slightly despite the massive earnings beat. This is where the deeper insight for investors comes in. The earnings beat and the subsequent raising and narrowing of their full-year 2025 adjusted EPS guidance is a direct signal of remarkable operational efficiency and cost management. The company is demonstrating that they have a firm grip on what they can control, their cost structure, even as the pandemic-related tailwinds fade, and they are now explicitly projecting approximately $7.2 billion in net cost savings by the end of 2027. This financial discipline is the key to understanding the current pressure on the stock because the market is hyper-focused on the revenue transition rather than the underlying profitability pivot. The general belief about Pfizer has been that it is fundamentally inexpensive, trading at an attractive valuation relative to the broader healthcare sector, but is structurally impaired by the sudden drop-off in its COVID-19 franchise revenue, creating a prolonged period of uncertainty. Investors looking for a stable income stream, perhaps utilizing Fidelity mutual funds for diversification or setting up a reliable distribution through a Schwab Intelligent Portfolio, often see the attractive dividend yield but get spooked by the multi-year decline in the stock price. The reality is that the narrative is shifting from a COVID stock to an oncology and internal medicine pipeline story, backed by aggressive acquisitions and serious cost-cutting. The non-COVID portfolio, which includes key growth drivers like Eliquis family, Vyndaqel, Nurtec ODT, Vydura, is growing at a robust 4% operationally, which is the engine investors need to watch. The stock's modest dip today is the market's initial, slightly confused reaction to an earnings report that signals a strong move toward fiscal prudence and core business health, which is ultimately a much more reliable foundation than temporary vaccine sales. The underlying profitability, which is a testament to management's execution on cost control, suggests the market may be giving undue weight to a modest revenue miss that was already largely anticipated. This is a classic tension between expectation, which assumes all pharma growth must be linear, and reality, which shows a sophisticated financial transition in progress. Daily price action for PFE has been characterized by volatility around these critical news items. Leading up to this morning's earnings, the volume had picked up and institutional activity showed a classic wait-and-see approach, with hedge funds not aggressively adding or reducing large positions, preferring to see the final numbers before committing. The stock has been trading tightly within a range for several weeks, oscillating between its 52-week low of about $20.91 and the upper range near $28. The volume today is elevated, suggesting a clear institutional reaction to the earnings news, even if the price movement is minimal. This implies a significant internal battle is happening between value-oriented institutions that appreciate the raised profit guidance and the clear focus on cash flow, and the growth-oriented funds that are disappointed by the slower-than-hoped-for growth in the top line despite the strength in the non-COVID segment. The stock's ability to maintain its price level despite the revenue decline speaks volumes about the value investors are placing on the dividend, which remains a key component of the company's capital allocation strategy, and the perceived safety net of its valuation. For an individual brokerage account holder, especially someone using Fidelity trading platform for deep technical analysis, the divergence between the strong EPS beat and the tepid stock reaction provides a complex technical pattern that is not simply a buy the dip signal, but rather a sign of a stock consolidating before its next major move, likely dictated by pipeline developments. Pfizer's business model is that of a globally diversified biopharmaceutical company focused on the discovery, development, manufacture, marketing, sales, and distribution of medicines and vaccines. Their core therapeutic areas include oncology, internal medicine, vaccines, inflammation and immunology, and rare disease. Before the pandemic, the company was already known for a blockbuster portfolio including Prevnar, pneumonic vaccine, Ibrance, cancer drug, Eliquis, cardiovascular, and Xeljanz, immunology. The massive, albeit temporary, success of the COVID-19 vaccine, Comirnaty and Paxlovid, redefined their financial profile, creating an unprecedented cash hoard. This cash is now the fuel for their current transition, most notably the contested acquisition of obesity drug developer Metsera for around $5.9 billion, a move that signals a serious intention to compete in the high-growth cardiometabolic space. Older reports, particularly from the pre-2020 era, often highlighted the looming patent cliff on key assets, but the pandemic-fueled cash flow has allowed management to execute a significant acquisition strategy to fill this gap, a critical move that will determine the company's revenue trajectory through 2030. When looking at Pfizer, or frankly any mega-cap pharmaceutical company, you are investing in a pipeline and a capital allocation strategy as much as you are investing in current sales. The recent deal with the government on drug pricing, where Pfizer offered to cut some drug prices in exchange for a temporary exemption from tariffs, also shows a shrewd political maneuvering that minimizes a potential macro pressure point for the business, further stabilizing the near-term outlook. Looking ahead, the future outlook for Pfizer is tightly bound to its clinical pipeline and its ability to integrate the acquired assets smoothly. The market expectation is still that the stock will remain somewhat range-bound until there is clearer visibility on the success of the new product launches. The key catalysts for 2026 will be the Phase 3 readouts for several of its advanced pipeline candidates, particularly in oncology following the Seagen acquisition, and any updates on the oral GIPR antagonist in the obesity space, which is currently in Phase 2. Success in these areas would provide the new revenue streams necessary to offset the anticipated $16 to $18 billion revenue loss from the patent expiration cliff between 2026 and 2030, which remains the single largest systemic risk to the stock. If you're managing an online investment portfolio and considering adding to your PFE position, you are essentially making a bet on CEO Albert Bourla's ability to execute this high-stakes portfolio transformation. The opportunity here is that the raised profit guidance, driven by cost-cutting, provides a comfortable margin of safety, a higher floor, while the pipeline assets represent the high potential upside. The low price-to-earnings multiple further reinforces the idea that the stock is priced for a poor outcome, meaning any notable success in a Phase 3 trial could cause a dramatic re-rating, significantly exceeding current expectations. Investors utilizing a service like SoFi Invest or considering self-investing need to weigh this risk-reward profile carefully. The key risk, apart from pipeline failures, remains execution risk. How efficiently can Pfizer integrate Metsera and Seagen, and how quickly can they scale up the manufacturing and marketing of new blockbusters in a highly competitive sector? This whole situation brings us back to the core expectation versus reality framing. The expectation was a messy quarter, overshadowed by COVID declines. The reality is a strong earnings beat, raised profit guidance, and a clear, fiscally disciplined plan to manage the post-pandemic transition, even as the top line still feels pressure. This is a management team trading temporary revenue for sustainable profitability and future growth. What do you think of this strategy? Comment below with which therapeutic area, oncology, vaccines, or cardiometabolic, you believe will be the biggest revenue driver for Pfizer by 2030, and why. Your opinion is part of the collective market sentiment that drives this stock. The summary here is that Pfizer is not a growth stock right now, it is a deep value transition play. The market narrative of declining COVID revenue is correct, but it overshadows the deeper, more important reality. A financially robust company is systematically de-risking its cost structure and aggressively buying its next generation of growth. The short-term price pressure is a reflection of uncertainty, but the